What's up, everyone? Welcome back to the Outlier podcast. I have my new friend, or soon to be friend, hopefully, Andrew Mack. I came into you actually through your recent work with Ewan Sinclair, who I've had on the podcast a bunch of times. Really enjoy his work. So, seeing the mix of what your angle is with markets, sports betting, and then Ewan's mix in that book was actually really, really fun to read. Looking forward to chatting with you.
Yeah, thanks for having me on, Eric. It's a pleasure to be here.
Beautiful. So we were just talking a little bit about the kind of beginning prospects of trading, right? And how a lot of people get into trading. You came from a slightly different angle because you span two worlds, at least from our lens. Most of my audience will be, stock market, options, equity, stuff like that. And you span two very different worlds with sports betting and then just general equity markets. So if you think about the two of them and you were asked to describe how are they the same, how are they the different, what do you come up with?
Well, that's a very long-winded answer to probably answer the entire thing, but let's start with the basics. Trading is betting. The foundation of all of these things is positive expectancy, right? And that element, which necessarily turns to topics of edge, the Kelly criterion, how much should you be risking to maximize your growth without ensuring your future ruin, and then risk management, all that kind of stuff. There are other ways you can look at it too. You can look at it in terms of the types of places that you find an edge, which would be, what we could call distortions of various types. Now, obviously, the distortions between sports and financial markets will be different, but thematically, they'll be very similar in terms of the kind of places that you might want to look. So there's a tremendous amount of crossover. The biggest differences, trading is, it's a continuous betting environment, right? Obviously, you have certain pauses like the end of the trading day or whatever, but throughout a trading day or throughout a trading week, or a year or whatever time frame you want to look at, it's more of a continuous bet. Whereas every sports bet, for the most part, has a deceded end at the end of the game or the end of the quarter or whatever. And I guess the strongest comparison would be live betting a sports game versus the market, because that's where you're going to find that things are really, really similar. Other than that, the convexity element in financial markets is different too, because we have fixed payoffs in betting on sports. So that's another sort of small difference that ends up making a very large difference in terms of sizing. And then you start talking about volatility, you start talking about Greeks, this and that. So, I mean, that's kind of a long-winded, rambling answer that's all over the place, but I feel like I got most of the important points there.
There's something you talked about a while ago with respect to like Bradley Terry models and using something to like a basic starting point, but then trying to find a good market to create this edge that you're talking about, whether it's looking for distortions. And one of them you were talking about was attacking smaller markets like the Icelandic women's basketball, which is
Right.
hilarious. I was just in Iceland. It's actually one of my favorite places. I love it there. But I did not see a lot of basketball, believe it or not. It wasn't everywhere. So I find that correlation actually fascinating because in markets, it's almost similar to what you were talking about, people that are trying to just bet on the NBA or trying to bet on the NFL, really big, dense markets. So if you were to think about that specific corollary, where can retail traders in equities markets find the Icelandic women's basketball equivalent, a space that might not be quite as saturated and a place to cut their teeth?
Now, it's a really good point because everybody wants to be known as the person that's betting on the NFL spread or the person that's betting on the NBA spread, because there's this I would say it's fake, but there's this element of like prestige around it. Like, oh no, I don't do any of that Mickey Mouse stuff. I'm an NFL spread better. And it's like, you're either making money or you're not, man. Right. Like, um, so a lot of the smaller sports get ignored because there's no prestige factor. And again, I use the term loosely. And the second thing is that the bettors aren't that interested in these sports. And so they think, well, I don't want to watch Icelandic women's basketball, for example. I don't even know where I could find that. Like what ESPN channel would that be on? But they're missing the point, which is that you shouldn't be betting on stuff that you necessarily want to watch. You should be betting on stuff that you have an edge, right? Like that's the whole point. If you're trying to do this to make money, if you're just trying to entertain yourself, I mean, that's a totally different conversation. And so, likewise in the markets, there are an awful lot of people, and unfortunately, it's sort of promoted this way by unscrupulous individuals at times. But people get steered towards ES futures, they get steered towards SPX 0DTE, and there's this idea that there's a prestige factor with index trading, right? And maybe again, hopefully, you're trying to impress yourself, your accountant, your bankroll growth, right? Like those are the things that matter to you. So yeah, it is a good idea to, take a look off the beaten path a little bit. What is the equivalent of Icelandic women's basketball in the financial markets? Now there's a question. The first thing that jumps to mind is there are a lot of opportunities in single stocks where they're not getting as many eyeballs. The liquidity maybe isn't quite as deep, and you're going to find some ability to capitalize on volatility distortions. Now, it's not exactly a free lunch because usually when you have spreads, and so the bid-ask spread will be a bit larger. In fact, in many of the cases, probably 80% of the cases, something that you find in some of these smaller stocks, the bid-ask spread has been widened to the point that it actually takes away, any positive expectation you have on the trade. And so 80% of the stuff that you find it's there, but you can't really, it's encased in glass. You can't really get at it because the market makers they're not dumb. They've widened the spread because they understand that there's some increased risk here. But, that little 20% edge, 20% of edge cases, you'll find something. And that, by the way, that's actually true in sports betting as well. So for player props and things like that, it's very typical for the sports book to increase the spread, like to increase the total vig that's being paid. So they're not, the opportunity is also the challenge. Like the reason that you can model a player prop really well is because other people aren't putting as much time into it. And the sports books certainly aren't as well. But what they do to counteract that is they say, okay, if we widen this VIG out to 8% or something, right, then we've got a lot of wiggle room here to sort of protect ourselves. And, there's a huge headwind for the bettor to overcome when they're betting into these markets. So, but yeah, I mean, there's lots of things in single stocks. Especially when the index, by the way, isn't moving a lot. Like when people are getting frustrated with the lack of realized volatility in the SPX or in the Qs or whatever, not a bad idea to start looking at single stocks, segment them by sector, segment them by subsector, and sort of say, okay, what's moving here? What looks like there is some inflows into this stuff.
It's interesting because I think there's a saying that actually gets contorted a little bit, which is, liquidity is king, liquidity is primary, got to look for liquidity, everything has to be liquid. And the message always makes sense, right? You prefer more liquidity. But I've always found an interesting juxtaposition. If you go on a place like SSRN, you'll find a lot of market effects driven by information and discreteness and coverage, and how many analysts happen to cover a stock and what kind of lead into momentum factor that can have and blah, 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 blah. So if we think about this idea of liquidity and how it's very frequent where we're really trying to maximize liquidity, what are your thoughts on striking that balance, though, to your point, where there are instances where if it's too liquid, it might be there, but you can't get it. But then, or if it's too illiquid, it might be there, but you can't get it. But then if it's too liquid, it just might not even be there. How do you go about like finding those opportunities?
Well, you raise an important point because, like you said, there's no perfect solution. When things are really liquid, the spreads get really small, which is great, right? Something that Ewan has said a couple of times, right, is that reducing your costs has an infinite Sharpe ratio, like impact on your trading. So obviously, less that you can pay in terms of pure cost is good. So we should be trying to find things that are liquid enough that are the spreads that we're attempting to beat aren't prohibitive, but highly liquid stuff is highly efficient stuff too, right? And so now you're looking for edge where you have the most money, the most eyeballs on it, and that presents a new challenge. And then on the other hand, right, things need to be liquid enough that you can actually trade them. I mean, there's lots of stuff that has edge that you won't even get filled on because so it's more like a hypothetical mirage edge. But so like you said, you're trying to find that sweet spot. I don't know if I have any like cut and dried rules or like principles in terms of like this is how you find the best mix. I mean, essentially what I would suggest is that whatever effect it is that you're trying to target, you're looking for what looks like positive expectancy edge, and then conditional on there being edge, then you're going to look into the logistics, like can I actually get filled, is this stuff trading, um, things like that. I would run it in that sequence, but I don't have any like I said, cut and dried rules on that kind of a thing, other than the importance of start with the edge and then filter down for what actually looks like you could trade it. Because there are a
Now,
lot of them that, something would look good, but you can't get filled, right?
right. Yeah. Now, the concept of edge is always super funny because everybody talks about it. You know, you're supposed to have it. It's almost like a buzzword, right? Everybody just says, get an edge, then go make money. And obviously, the game of trading is it's wrapped up in literally in that one word, and trying to create it or maintain it. So, if you were thinking about different skill leveled traders starting with beginners, what's a reasonable place to start looking for edge? And for those listening, the giant caveat here is for newer traders, this is under the premise that they have already guided their expectations. And probably what we're going to talk about is some sort of grindy slash not hyper sexy way of doubling your account every 6 months, right? Like we're talking about the actual skill of trading, which typically doesn't look quite like that. So, all that aside, for a beginner, if you were to give some ideas on where they can start looking for edge, what kind of market effects or profit mechanisms might be worth their time, in air quotes, what might be good places to start?
Well, what's worth your time is a slightly different question because that's sort of conditional on how large your bankroll is and how much you need to get down on a bet or a trade to appreciably move the needle, right? If you have $5 million, yeah, what you're going to be looking at is probably fairly different from if you have $50,000, right? Like those are two totally
I
kind
think
of different scenarios in terms of the what you need to actually move the needle. But to get to your question more specifically, take one step backwards from edge. Before edge, it's effects, and you use that word. It's the right word. You're looking for market effects, and so you'd start trying to build up your sort of mental repertoire of different market effects. Effects like the VRP in options trading, effects like the equity risk premium, effects like momentum, um, effects like mean reversion as a general principle. And then you can dig into, Are there subsections of the market that show better or worse results for these types of things? Is there a way to make some tweaks to the concept of momentum to identify things a little bit better? Is there a way to roughly time the VRP so that we can get some sense of when it's better to be on a short vol trade and maybe when it's a bad idea to be on a short vol trade? And then that can lead to a little bit closer to the types of stuff that I do, which is the inverse of that, which is there a better or worse time to be on a long vol trade, right? Because, in that counterparty dynamic, when it's a bad day to be a short vol seller, it's a good day to be a long vol player. And so, you know, and a lot of that has to do with trying to understand the people that are in the market, your counterparties, the other operators, what they're trying to do, how they're trying to do it, and get some appreciation for how these things sort of interact with each other. And if you have some idea of how that is all these different moving parts are coming together, it will give you ideas for where you might find effects. And so that can lead to things like the timing effects, like the OPEX week, end of the month effect, all of these sorts of things. Like that's kind of how you start breaking these things down so that you can start creating lists of things to investigate. I actually think that you would start with kind of general effects, and then you would take a look at the counterparties, the other people in the market, and the kinds of things they're trying to do. So you can understand the pinch points. You can understand where these people might buy or sell in a panicked state at prices that they might not want to. And again, another way to sort of look at where the pinch points might be so that you can find these effects and then you can test them to see if they have edge and then proceed on until you're putting money down on these things.
If you were to pick one of those, whichever makes you happy, and you were to begin the process of testing for edge, what are the broad muscle movements? And a quick shout out actually here to your guys' book, Retail Option Trade, because it talks about this, but figured for just a general overview for those that are listening, what might be a good way to start that process?
Well, that situation you'd find yourself in is you have some kind of an effect and it looks legit. At that point, like we talked about in the book, you can do some Monte Carlo simulation to try to get a sense of the effect. From there, you might think about doing a walk forward test. Most people would tell you that the right answer at this particular juncture is to do a back test, right? To get in there and do a back test. Yeah, you can do a back test. Back testing is fine, as long as you understand that it's telling you what has worked in the past. If your effect is a risk premia, that's a good idea because that's going to help you really quantify the edge. And since it is a risk premia, it's not something that is likely to be ironed out of the market. And so for that reason, we can use a back test and glean a little bit more information from it. If you think that it's more of a distortion or an inefficiency, a back test is probably going to give you a false sense of confidence, because just because something has worked previously doesn't mean it's going to work into the future. And something that I've noticed recently is that the market on close for 0DT options, it's kind of changed a little bit the last 6 months, right? It looks to me like market makers have a much better handle on the market on close now than they did a year ago. And so, for example, you could have back tested some kind of a market on close strategy where you're looking for cheap options to buy and getting like a very, very quick trade in at the end of the day. And if you were trying it right now, your results probably wouldn't be what they were a year ago. So that's why I kind of like the walk forward test idea better, because it gives you a better sense of at least how things are roughly doing now. And you can argue about including transaction costs and things like that, but the level of detail you want to do in something like that. But I think generally the walk forward test is a better way to go. The other thing I would add to that, it's something that I commented on Twitter, is that you also want to try and understand the environment that whatever this effect you're trying to harvest works the best in. And so this can be like really simple, like almost dumb sounding things like, is the market above the 200-day simple moving average? Like, so if you're trying to be short volatility, you're trying to sell straddles, sell strangles, iron condors, whatever. It's good to know, like, hey, does this work better or worse when we're above the 200-day SMA? Does this work better or worse when we're in backwardation or contango? And hopefully viewers know the answer to that one. Does it work better or worse when the VIX is above or below, its 200-day average? Does it work better or worse when the VIX is above or below 21 or 16 or 25, right? Because that can help you understand when it might be a bad idea to do the thing that you're thinking about doing when they're, and it can kind of give you some ideas about how to improve the strategy moving forward as well. So I would kind of add that into the walk forward test, is like, it's good to track some of these environmental conditions just to see if anything moves the needle a little bit.
How do you think about striking a balance between seeing something, being relatively confident it's there, versus continually testing over and over and over and over and over again, and essentially just being a pussy and not putting a trade on? Like, I think a lot of traders get stuck in that. So how do you think about validating something enough so that then you can move to production?
It's a good point. There is, it's a very, very sophisticated form of almost procrastination to just continually be back testing and never actually doing anything. The market is where back tests go to die, right? Like when you actually contact the order book, that's when you're going to find out what's real and what's not real. And like I said, while there are things we can learn from back testing and walk forward tests and Monte Carlo sims that are very important, at some point, you do have to fire on these things and collect the data and sort of see how well it's lining up with whatever you thought you had learned prior to executing on your strategy. It's really important. There are people that you see out there, they're going around in circles, testing either two categories broadly. Some people are testing 100 different things and never actually doing anything, and other people are retesting the same thing 100 different ways and not doing anything. And I mean, at some point, it is a hands-on activity, right? Like, you do have to actually put the trades on and get the feedback from the market with, the cost in there, the market impact or response in there, all of that stuff. Very, very important. Did I answer that question, or did I miss a part?
Partially. So then the main part going forward then will be, after they do some of their back testing, forward testing, Monte Carlo sims, how do you bucket the stuff in your observation that's like, I have to see this in order for it to be viable, so that you know that you can move forward with it, versus having complete certainty? So the way I think about it personally is, if I'm testing something, there are certain features that have to be there in order for this thing to be viable, based on whatever the effect is that I'm trying to trade. And I'm trying to think about, or I'm trying to explore how you think about finding that balance between data collection, coming up with what things really matter in order to move it, versus we're just testing now for the sake of it.
So there are a couple of things. I think people probably would expect to hear something about statistical significance, p-values, maybe some Bayesian Bayes factor stuff, like things that are going to try and quote unquote prove to you that you've got something real. And I would suggest that you're not looking for proof, right? If it's like complete, first of all, I've got a book talking about why p-values don't mean necessarily what you think they mean, and they're sort of give you a false sense of confidence. You are looking for an effect that appears to be strong, which you can get hopefully from the Monte Carlo sim part of your process. So hopefully you've already got that at least. You're saying the effect looks like it's a thing. Now we're just going to find out if we can actually make money from this thing. And um, so with regards to the statistical significance, you do want some data. Hopefully that walk forward test is going to give you some data. But then I'm going to start firing on it. What I want to see are things that are telling me that the payoff ratio part of the Kelly criterion looks pretty solid. So generally speaking, I want a positive payoff ratio. Um, I'm prepared to accept a lower win rate for that with what I do. But what I don't like personally for me, what I don't like to see is something that is reliant heavily on the win rate. It's something that I carried with me from sports. Sports is a little bit different because the payoffs are fixed. With options, especially with long options, like directionally, you have the convexity element, right? And so hopefully you're able to actually capture some of that convexity. Your payoff ratio should be healthy on these trades, and you're prepared to accept a lower win rate in order to collect that. So generally, that's what I'm looking for. It's possible to do all kinds of little tweaks and things that will actually truncate the convexity and take a positively skewed strategy and turn it into a negatively skewed strategy, for example, with options. So I like to try and focus on the payoff ratio and the stability of it. What I don't like to see is something, like I said, that heavily depends on the win rate, because win rates can be very environment dependent, as short volatility players found out in March and April. And that's kind of the main thing that I'm looking for. There are a couple other things too. But with what I do, which obviously, that's what I know the most about. That's the main thing that I'm looking for.
Got it. Yeah, the win rate is a personal pet peeve of mine as well, just for retail options traders specifically, because I also think it becomes a mental disease where you get used to most of your trades winning, and even if you look at the end of it and then it's not really that great of a result, because there's so many individual samples of winning, it can still feel and mislead people pretty heavily. So I fully resonate with that component. Now, if you run the strategy and let's say you test it, things look good, you start firing on it, it's live, there's this new inject of path and just what happens to happen. One of the things I struggle sometimes to explain to people is when you move something and you start using it, those first iterations of whatever you get, it's very difficult to tell a lot from it. You obviously need to get something that's a little more representative of whatever the effect is that you're trying to trade against the strategy. How do you think about when you move something, it's live, and how do you monitor it based on maybe like first and second phase, where first phase is it's really low sample size? What do you look for in that window? And then let's say maybe if you continue to keep it live and then the sample size grows, what do you look for in that window for your feedback loop?
Well, you probably want to combine the total sample size as it continues to grow, as well as some kind of a rolling set of metrics that's sort of showing you almost like the trend of your results, so that hopefully if there's something starting to diverge, you can see that before you go down with the ship. And that's something that I picked up from sports when I figured out that a sports season is not uniform across the entire thing, that like you can kind of break it into different segments based on how much data is available and whether we're past the trade deadline. And there are things that sort of change what works the best depending on kind of what segment of the season you're in. And I figured that out by looking at my results and noticing that certain strategies did really well early season, and then they started to diverge from what I would have expected after the trade deadline, things like that. And so you want to be paying close attention to divergences between kind of like the rolling metrics of what's been happening over the last month versus the last year, things like that.
And one of the follow-on difficulties I have with people sometimes, just in conversations, this is specifically for those I would consider at like the late beginner, maybe, you know, early intermediate stage, whatever that means, but just general context, is sometimes they'll move a strategy, they'll have a couple results, and they'll say, "Oh man, I'm 2 for 2. This is great." Or they'll say like, "I'm 0 for 2. This is useless. This isn't working." What's your response to like that mental framework? Because obviously it is laughable.
Yeah, I mean that it's insane to come to those conclusions based on, you know, two spins, right? Like you need help if that's the kind of the where you're at. You're holding the stick way too tight. It's impossible to know anything from two spins of the roulette wheel or two hands at the poker table. Like there's just no information in that at all. And what you get from that, you see this a lot. You see the strategy hopping, right? Where if something gets hot for, you know, 3 or 4 or 5 trades, then I'm a genius, and I should start betting 40% of my bankroll on this, right? And if something loses 3 times in a row, it's like, you know, it's the JPM collar trade out to get me, or it's the market makers, or it's just a overweighting small observations way too heavily. Impossible to know anything from that, right? And that hopefully that's why you've done the work of trying to find some kind of an effect and taken a really good look at it before you did this, so that you know, okay, we're going to have to do this a bunch of times, right? Hundreds of trades in a trading career, thousands of trades, tens of thousands of trades, depending on your time frame. So 2 trades really, you know, shouldn't make or break you either way, and shouldn't affect you psychologically or emotionally either. If it is, you know, maybe you don't understand the effect well enough and it feels like magic. Maybe you're betting way too much, and that's why you're overreacting to every single thing that you're seeing. Like you're probably right on the train tracks for risk of ruin territory if that type of thing is happening to you while you're doing this stuff. Because one, two, three, 4 losses in a row, 4 wins in a row, it shouldn't affect you too much, right? It really shouldn't.
It's and there's really two follow-up directions I want to go. The first one though is to talk a little bit about the psychological component of things, because we were talking about this in the beginning, and I think a lot about the beginner trader, because I remember being there, and I remember like all of the things that you're hoping to do, and most of them are just complete pipe dreams. But you mentioned an important thing where, as you're building this strategy, you need to make sure that you're able to give it enough runway to see, like, is this thing viable? And that's something that I've developed a process around, but I'm curious from your lens, as you're in the scoping stage of a strategy, before you choose to take it live, do you have certain metrics already built in your mind where it's my average should fall within these levels? I would need this many of observations in order to accurately feed this back into the system and derive information from it. How do you go about that?
Yeah, you definitely want to have some idea of the less exciting metrics, like your average drawdown or your maximum drawdown. These are things that you're not going to know with certainty before you start, but you can simulate win rate and with some variance around it, and you have an estimated payoff ratio with some variance around it. You can simulate that, and you can simulate what the drawdowns might look like. You can sort those into quantiles. You can do all kinds of things to get an idea of like, if this goes bad, how bad could it go? And what are kind of the rough guide rails in terms of where this thing should perform, even with some randomness mixed in. Definitely, you want to have some idea of that. And I know that uh, astute viewers might notice that referencing win rate and payoff ratio in this way would be the wrong implementation of the Kelly criterion, because the Kelly criterion in financial markets, normally we're using mean return and variance. So it actually looks closer to a Sharpe ratio. But just conceptually, right? Like, this is one of the ways that you can give yourself an idea of like the kind of drawdown or the kind of turbulence you might expect, right? And then also the type of strategy you have. If it's a high win rate, low payoff ratio strategy, that's going to have different drawdown qualities than a low win rate, high payoff ratio strategy. So all of those things would kind of go into consideration, but you should be aware of them, not because you're going to be able to calculate them with any certainty, but because you want some idea of what you might experience along the way, so that as you're getting the live results, you're getting the feedback from the market, you don't get freaked out when you have a bad week or you have a bad month or whatever, right?
Now, when you're implementing something like the Kelly criterion, I assume you're using some sort of fractional variation of it. How do you implement it with a broad portfolio, though, that might be running X number of strategies? So maybe the easiest way to answer this is if you could give us an idea of like what a standard portfolio might look like. And again, you don't need specifics, but I'm thinking like number of strategies, number of trades, and then that'll help map how you use the Kelly criterion in that mix.
Well, you and I talked about this in our book. There's a small section on this about correlation between strategies and how that ties into the mix with using the Kelly criterion. We also talk about fractional Kelly as well, because it's a very bad idea to use full Kelly, generally speaking, because it's always an estimated number and we don't know what it will be moving forward most of the time, which means that you run the risk of betting over Kelly, which people familiar with the math knows that that's the path to blowing up. And so the idea is to have some estimate of the Kelly criterion number, but to always be, a healthy amount below the full amount. So you end up with quarter Kelly or something around that. In terms of how many strategies running, I have a number of strategies, but the reason that I have a number of strategies is because the environment is changing, and strategies don't work all the time, right? And so there is a time when it makes a lot of sense to be long a straddle, but most of the time being long a straddle is a losing bet. And so you've got a long volatility, long straddle strategy in your bag of tricks, your tool bag, but it's not the thing that you're going to be using all the time. When we're in a low vol environment, you probably want to be able to participate in the market generally going up, the equity risk premium. So, you'll have a strategy for that. That could be momentum. That can be looking for breakouts in single stocks. It could be a number of things. And so it's good to have a number of different strategies, but I guess what I would recommend is that try to find things that are complementary like this, so that you are versatile and adaptive, so that when the market environment changes, and the environment we're talking about can be the volatility environment, it can be the general, equities market, you can look at that, slice it and dice it a number of different ways, but the idea is to have complementary strategies that allow you to continue to find trades with positive expectancy, regardless of where we're at in the market. So it's not really about running them all together for me, at least. It's about recognizing the environment you're in and then using the right tool for the job.
And is this part of the reason why you like to stay both in equity markets and then also sports betting? One of my curiosities is what prevents you from like highly specializing in one or the other?
Um, well, I told a little bit about this story on another podcast recently, but I put a lot of time into the trading side of things when the sports markets were going quite squirrely because of the COVID-19 pandemic environment, because all the players were getting pulled into COVID isolation protocol like 5 minutes before game time, and it was really messing things up for some of my player-based stuff. Um, at this at this point, it would probably make sense to just specialize rather exclusively on financial markets. Um, but I've got all the infrastructure built, all the models, all the databases for sports. So it's not really taking a ton of time anymore for me to do that stuff. And so the compromise that I've made is that I'm only betting on regular season now, and I don't bet on the playoffs, and I take the summers off, and I don't bet baseball anymore. And that's kind of how I've slowly put together some semblance of work-life balance. Um, but the liquidity, like how much you can get down in the financial markets, is obviously orders of magnitude larger than sports. And so it makes the most sense for me to keep putting the majority of my focus on that. Um, and in truth, I've thought about cutting a few sports from the portfolio. I've thought about cutting basketball and hockey just because the amounts that you can get down are not significant to me anymore. So if I was going to do anything in terms of changes, I would probably stick to betting NFL and trading. Something I'm considering over the summer.
Interesting. Yeah, I was thinking about it, and I could see it a bunch of different ways. Like there could be just an interest element as well. Obviously, there I imagine there's a subcomponent of that, but I also find, at least for me, the market is plenty. It's actually a lot in terms of different ways to get involved and constantly tweaking. So it makes sense on how you strike a balance there, because I was sitting here thinking like, man, that would be really challenging to trade at a high level and then also be, sports betting at a very high level. But you also have a lot of experience there. When
Mostly it's just the benefit of the systems that I have, right? It doesn't take a ton to refresh the data, run the models, and give me things to look for. Where it started to become a little bit of a grind is that, with trading, you know, if you're not trading, if you're trading, main stuff, right? A Friday, you're done. You've got, a weekend, and then you go back to it. With sports betting, I mean, it's around the clock, right? In terms of like every single day, there's going to be games on, and so I think that that football still fits nicely in because there's good liquidity that you can get down on spreads and things like that. And but also, you've got Monday, Thursday, and Sunday, and so it's a little bit more structured that way. So, like I said, it's something I've been thinking about, is maybe just retiring the hockey stuff and the basketball stuff. I guess we'll
yeah,
see.
yeah. When you're looking at these two different worlds, I'm very curious. It was funny before you were talking about some of the evolutions you see in like zero DTEs, which I trade those pretty regularly among a slew of other stuff. But how do you assess the rate of environmental and structural change between sports betting and equity markets?
The rate of change.
Structural, or yeah, so I'm thinking, for example, what you were talking about there with the market makers and zero DTEs, at the end of the day getting a little more privy and tightening up the way that they're running their end of the day activities. Do you see that same kind of reactive component in sports betting where you're constantly seeing these small changes happening in the spreads that are provided or in the way that you're analyzing that stuff? Or is it kind of set and it doesn't evolve quite as quickly? I don't have really a deep sports betting background, as I'm sure you could tell.
Um, I wouldn't say that it's set. I mean, one thing about sports is that you get a lot of rule changes from year to
Interesting.
year across the various leagues, and usually those rule changes make some material changes to the total, to the scoring environment in some way, right? I mean, an old example would be, when the NHL changed the size of the goalies pads regulations, or when they changed the rules about two-line passes, which made breakaway passes more viable. And then you've got offensive and defensive pass interference in the NFL. Then you've got the change in the shot clock in the NBA when we went from uh, to a smaller, like a shortened shot clock, which materially changed the average total on a basketball game. Then there was one, I think Barry Horse a few years ago mentioned something about the base sizes in baseball, and people were reacting to that. So there are all kinds of, and then of course you've got the baseballs themselves, right? Which there's been a bunch of interesting analysis done into changing the manufacturing process of the baseballs and changing the scoring environment and
Man, that goes
all
deep.
these kind of things. So you have things like that that are changing all the time. Um, and so it's important to react to that. It's important to be kind of have your eyes open and constantly be on the lookout for these things that might move the needle in some way. Um, I guess the other thing is that there are no risk premium in sports, right? It's all inefficiencies, distortions, or else you're losing money. And so that means that when these things become part of the market, they people are reacting to them. People that are doing a good job at this are reacting to them pretty quickly. Um, I don't know if it's faster or slower than financial markets. It would be hard to say. I would think that it would be slower just because there's more money involved, more
Right.
more eyeballs on the financial markets. But you see a lot of. So I guess that would be probably the safest default answer. But you know, you see the markets react pretty strongly and pretty quickly to things in sports, though, too. So
Yeah, it's just an interesting general curiosity trying to understand more of like the difference between the worlds. It leads to a interesting market example. When the Trump tariffs came out, what did you think about the market's general volatility leading into that event and then out of that event?
well, I had two of the best months of my trading career during that time. So I thought the volatility was wonderful. But um, what I recall more acutely about that time was that there seemed to be a very strong confidence, and I would suggest overconfidence um, that the presidency was going to be like sort of an up only presidency, that the stock market was going to absolutely rip. And there was a more minority voice that was sort of quietly whispering that, some of the papers that were being circulated and things about how they were prepared to let equities fall a little bit, and maybe that would do something to the rates they would pay on government debt and things like that. And so to me, it looked like the fragility was to the downside. It looked like the fragility was exposure to long volatility. Um, Now that alone isn't a reason to take a trade, but that's kind of when I start looking for other signs, looking for other things so that I could get positioned to take advantage of that. And I got a little bit lucky because we did get the volatility. And so to me, it's much more interesting to look at when one side of the boat is overloaded. When there's an off balance in terms of confidence that this thing can only go up or it can only go down, or this is a short vol environment, and you start seeing people crowd into the short vol trade, um, it's really useful to try to think about where the potential fragility is in what's happening. Just not because it increases the chance of that thing occurring, but because that's where the big payoff value is if you're ready for it. That's sort of my general take on that stuff. So
Yeah, a
yeah,
bit
it
of
was a
a
very, very wild time. And interestingly enough, we saw a lot of disbelief when when we started seeing the first big realized vol to the downside. You saw a lot of initial disbelief, and which was, ended up being a good sign because we got some really explosive days.
How were you generally positioned when you were trading it?
I was long puts.
And then were you just trading them in the primary indices? Do you focus in one, or do you spread between multiple indices? Did you think small caps were going to be more susceptible, or?
When I generally think there's a long vol opportunity, I'm looking at the indices. So I'm looking at the Qs, I'm looking at SPY, I'm looking at SPX index, ES. That's kind of where my attention is focused when I think that we're shaping up for a really nice long volatility environment. And then of course you're looking at the VIX complex too. You're looking at the term structure for VIX futures. You're looking at the VIX. You're looking at VVIX. All things that can help sort of give an indication if that fragility that you think might be on the horizon could actually be there, right? Like where are we in terms of that complex as well? And if you're looking at that, then it's handy to be targeting the indices, right?
And how do you choose the actual structure for your trade? Do you try to spread across expirations to have some near front convexity and gamma and have some longer term stuff in case it takes a little longer? Or are you like primarily trading it around the catalyst itself of the tariff announcements? How do you think about that?
Well, yeah, probably a little bit more lean towards the catalysts themselves, but I also like to pay attention to where we're getting the volatility from. So I'm looking at the intraday overnight ratios, and I'm trying to see, like, is this being pushed like after hours, like, or is it intraday? Like, where are we getting the vol, and are we seeing any changes in that ratio? Because sometimes big moves get dampened in either direction because most of the move is happening outside of the regular trading hours, and so it's really good to see where is that realized volatility coming from in terms of the intraday overnight ratios. And depending on what you see, you might be trying to position yourself for a long straddle that you hold overnight, for example, which normally wouldn't necessarily be the best idea in the world, but there are situations, and we did see some during that time frame when it was a great thing. So yeah, generally speaking, pretty short term time frames, like intraday catalyst stuff, some overnight stuff, weekly stuff, things like that. I'm not usually looking too much further out for my main strategies longer than about a week. There are some, slower moving momentum stuff where I'm holding things for longer than that, but the bulk of my focus is on, I guess, what would be considered pretty short term timeframes.
Yeah, it makes sense, especially with the type of positions that you're talking about. A couple other questions, just out of sheer curiosity. When you're looking at something like the Trump tariffs, there's obviously a breakdown in something like the efficient market hypothesis. We already know that the strong form doesn't exist, but we do know that markets are fairly efficient. They're not like, obnoxiously inefficient. Yet it's really interesting to find instances like the initial Trump tariff announcements where it does seem like the entire market almost got caught completely off guard. What do you make of those kind of instances when there's clearly well, whether you want to call it an inefficiency or not, but there's clearly a big discrepancy between positioning and what information is known and then what happens?
Yeah, I don't know if I would call tariff announcements an inefficiency. I would probably call that a catalyst, right?
Yeah.
Because the truth is that shit happens, right? I mean, war breaks out, or you know, a tsunami takes out a supply chain that's critical to the world in some way. Like, these things happen. And while I'm sure that there are ways to try to get a handle on that, with forecasting and this and that, there are lots of catalysts around the world, political, environmental, whatever, that they just pop up, and we get unappreciated volatility, or unexpected volatility. So I don't know if I would call that, an inefficiency per se.
What, just quick
What's
inject.
interesting about those moments to me? Oh yeah, okay.
Yeah, no, I just had a quick question on that because I agree with you in terms of like the catalyst, but I guess the specific component I'm really curious about is that catalyst is fairly unique in that it was well known, right? Like we knew when they were being announced, we knew the date, we had some prelude into like what might be announced. So to me, it's like, it surprised me to see the market positioned as it was coming into that kind of event, obviously mispricing it. So that, just to be clear, like that's the specific part of that curve that I'm curious on your take of like how the market positioned coming into that.
Well, like I said, I think what was really interesting about that was the overconfidence about what that was likely to mean, and that this administration was going to be up only, or whatever. I mean, there was a lot of confidence about what this was going to mean extrapolated into the future, and that confidence produced some very uh, unbalanced positioning in one general direction. And there's a lot of permutations in terms of how it was traded, but it created potential fragility to the downside for realized vol. And it didn't increase the probability of getting downside vol, because who knows what could have happened in alternative scenarios. But I think what was interesting about it was just that the effect ended up being a lot stronger than it otherwise would, not because of an inefficiency, but just because the positioning was so unbalanced. And so that's kind of what I was trying to say before about like looking at where the fragility is, because that's
Right.
where the biggest potential payoff is, and when a surprise happens. And it's not that you think you have a high probability of the surprise, it's that the payoff for this surprise is starting to get into the territory where this is becoming positive expectancy to bet on this, even though it has a low chance of actually occurring. And I think that's what you saw there. Just a lot of very confident positioning that left an opening. And when Vault picks up, and when VIX picks up, and when VVIX picks up, and the term structure starts to lift, it has a lot of cascading effects in the market. And I'm sure that there are levels of detail to that I don't even fully understand at this point. But there is a very large snowball effect, especially to realize vol to the downside. And what we saw was sort of that all coming to fruition at once.
Yeah. Yeah. Interesting. Well, awesome. I had one last question slash just general topic for you. If you think about your time frame of trading in general, combining, let's say, both the sports betting and then the market side of stuff, how has your overall approach and process evolved in general? You don't have to be super hyper specific, but curious, what are like the main things you noticed as like key changes to what you do over time?
Well, with sports, the first real beachhead that I had was with player props and modeling player props. And so I got really into the modeling element and then started constructing, full games out of uh, estimated minutes played and rosters and lineups and things like that. As I moved to sort of the next levels, I realized that there were stronger effects, but you had to completely revamp the approach so that it was no longer about taking the players, combining them, you know, adjusting and accounting for covariance and correlation between the players based on the given lineups. But there was a number of completely different approaches that were more market-based approaches that were really, really useful. And a lot of those market-based approaches were things that I was able to take into the finance world and use effectively. Obviously, we needed to tweak them a little bit because it's not exactly the same, but there were many things from um, the market strategies, the market models in sports that I was able to transpose, you might say, into the financial markets. And what's interesting is that in options trading, I found a number of things that are actually quite useful for sports betting.
Mm.
Looking back on it now, I don't want to get into that too much, but the amount of crossover that I appreciate now between sports and options trading specifically is enormous. Probably more than I ever thought I would see. And I guess that I mean, my approach really is like a sports betting based approach to trading, which is kind of hard to explain. And some of it I'd prefer not to explain because it's working really well. But I guess that my approach changing over time, probably more market rather than player based in sports, and then just appreciating the amount of transferability and using everything that I learned in sports in the financial markets to the maximum that I can. Because I didn't totally see that connection when I first got into trading, and the longer that I've been in it, the more I appreciate how similar they are and how useful the tools are in the opposite world, you might say.
Last question. How would you characterize the concept of implied vol between sports betting and markets? Obviously, not a direct corollary, but imagine there's some artifact.
Yeah, so I actually had a tweet about this recently, but if you take the NFL, take any game and look at the point spread, there's a main line for that point spread, and you could think of that like the at the money strike.
Mm-hmm.
Now, every time that I bring this up, there's somebody that replies, but they're not exactly the same because options have convexity and sports have a fixed payoff. And it's like, yeah, we get that, right? Like
Thanks, bro.
so sports, if you look at it, yeah, if you look at a sports spread market, it's more like a binary option because the payouts are binary, right? Okay. But the concept of the strikes is the important piece. So if you look at the main game spread line, that is the at the money strike. And then as you go further out, either way, you have alternate lines. You could buy points to reduce the spread for a favorite. You could sell points to increase the spread for a favorite. And it changes the payout that you would get in the betting market. And that's just like the strikes that you see, or at least very similar to the strikes that you would see on an options chain where, you're going deeper into the money or deeper out of the money. Same concept. And you'll notice that when you look at the implied volatility service, that the implied volatility, which we can consider a proxy for the price that you're paying, the vol that you're paying for these strikes, it increases as you get further away from the at the money strike. And there's a smile. Sometimes it's a smirk. Sometimes it's relatively flat on one side. But that's the general concept, that you're going to pay a higher vol as you get further away from the at the money strike. Well, in sports betting, if you look at, because you don't have an implied volatility, but if you look at the total VIG for each line, for each strike, what you're going to see is that if you get further away from the the main game line, you pay a higher total vig as you get further away from the at the money strike. And so it's the same concept, right? The sports book is saying, if you want this, far in the money or far out of the money spread on this game, we're going to make the implied volatility, the implied volatility or the vig in the sports book's case larger to account for either higher probability of payoff or more uncertainty, etc. And so if you look at it that way, you realize that the market maker and a sports book are doing very similar things. And you can find a lot of utility in thinking about it that way, even though they're not exactly the same.
It's a great way to look at it. The thing that really made me think about that anyways was when you were talking about during COVID, right? And like 5 minutes before the game, a player's getting pulled for something else. And it's like, damn, like that's a big inject of vol that is very difficult to model. I mean, obviously you can build one over time for something like that, but I thought the relationship there is really, really interesting. But thank you for explaining a little bit more about it, because it does help. Andrew, had you for a little while and really, really enjoyed chatting with you. I'd love to have you on another time. I know it's Friday. I'm sure you got stuff to do as much as I can. I could go on forever because this stuff is so freaking fascinating to me, but I realize people also have lives to live. So I'd love to, keep in touch and have you on another time. But in the meantime, folks, they can find you on X. I can throw a link to your profile below. Anywhere else that you'd like to send people to check your stuff out?
I think that's it. I mean, I've got a link in the bio for the Amazon books and various YouTube videos and Spotify podcasts, all that stuff. You can find it all there. So that's probably the best way.
Beautiful. So everybody, you know where to go look to find more about Andrew. Thanks for hanging out. And then we'll see you guys on the next episode.